Good morning, this is your DealBook briefing for Thursday, August 20th, 2026. I'm Andrew Ross Sorkin, and we have a packed edition today, from a stunning Treasury intervention that's rattling the Fed's independence, to a $40 trillion debt milestone, a life sentence for China's most infamous property tycoon, a cancer vaccine breakthrough, and what might be the signal that the AI boom has entered its consolidation phase. Let's dive in. The big story this morning, the one that had traders glued to screens before the opening bell, came out of the Treasury Department yesterday afternoon. Secretary Scott Bessent, the former hedge fund chief who made his name betting against the British pound and the Japanese yen, unveiled a plan that caught almost everyone off guard. The Treasury will at least double its repurchases of longer-dated treasuries, spending up to $4 billion at a time, at several points between September 9th and November 4th, the day after Election Day. The market reaction was immediate. Traders piled into 30-year Treasury bonds, pushing yields lower. The dollar weakened. Stocks barely moved, but gold and cryptocurrencies surged as investors digested what this really means. Lawrence Gillum, chief fixed income strategist at LPL Financial, put it bluntly to DealBook, "I think it's just jawboning to get market yields lower, calling it a temporary fix." But the message, he warned, could have a more enduring effect. Bessent has put traders on notice that the Trump administration will intervene in markets to lower borrowing costs. After efforts to prop up Argentina's currency and the struggling Japanese yen, Bessent has been called the most interventionist Treasury Secretary in decades. And that brings us to the tension at the heart of this story. Kevin Warsh, Trump's hand-picked Fed chairman, has been signaling a growing focus on raising rates to bring down inflation. Bessent's desire to lower yields, to bring down prices, appears at odds with that mandate. Gillum told DealBook, "It probably means more volatility ahead within the rates market." The question hanging over Washington this morning, did Bessent take the Fed by surprise? And more importantly, what happens when the Treasury Secretary's trader instincts collide with the central bank's independence? There's precedent here, and it's uncomfortable. In 2024, economists and Republican lawmakers criticized Janet Yellen, Bessent's predecessor, for intervening in the Treasury market ahead of the general election. Joe Bruswalis, chief economist at RSMUS, wrote to investors yesterday that Bessent's interest is purely short-term and is organized around the upcoming election and not a return to price stability. Market observers are now wondering if Treasury market interventions will become a permanent feature of American politics, or at least more frequent so long as Congress fails to address ballooning federal deficits. Speaking of which, the United States hit a grim milestone this week. Gross national debt topped $40 trillion for the first time. This year alone, the country is on track to borrow more than $2 trillion to pay for obligations including the war in Iran and the sweeping tax cuts Republicans enacted in 2025. Soaring interest payments to investors are consuming a growing share of the federal budget. Economists and Fed officials have long warned this borrowing trajectory is unsustainable. The milestone has spooked the bond market, but the prospects of either party moving to reduce it remain remote at best. President Trump's promises to restore fiscal order have been undercut by spending on the Iran war, tax cuts, and tariff refunds. Now, let's turn overseas. A Chinese court sentenced Hui Kai-yen, the founder of Evergrande, to life in prison yesterday. The punishment came after he pleaded guilty to charges including misuse of funds and fundraising fraud. Evergrande's collapse in 2021 brought China's financial system to the brink, and the country's property market is still languishing. Hui was also ordered to forfeit all personal assets, a remarkable fall for a man who once belonged to an elite group of political advisors and cultivated the image of a patriotic tycoon. His sentencing caps the downfall of a property empire whose collapse set off a prolonged crisis in the Chinese economy. Back in Washington, President Trump is urging Congress to pass the Clarity Act, a sweeping cryptocurrency bill that would establish national regulation for the industry. His support prompted a rally in Bitcoin and other digital tokens. But the legislation has stalled in the Senate amid concerns over national security and whether it does enough to stop the Trump family from improperly benefiting from crypto. The sticking point, the $1.4 billion in crypto revenue Trump disclosed in June, after a year of astonishing money-making by his family's network of crypto businesses. Senate Democrats are pushing for strict language to bar the president from selling crypto while in office. The bill inches toward a final vote this summer, backed by an industry that has spent tens of millions shaping it. In medical news, shares in Merck and Moderna soared yesterday after the drug makers announced promising clinical trial results for a personalized mRNA cancer vaccine. The experimental vaccine prevented the return and spread of cancer in high-risk melanoma patients, allowing them to live longer cancer-free.
Stefan Bancel, Moderna's CEO, called it a big moment for medicine.
Dr. Elias Sayar, a pediatric oncologist at the University of Florida not involved in the trial, said the results could help usher a whole new wave of new therapeutic treatments for cancer.
The mRNA technology instrumental in COVID vaccines is showing its versatility. But regulatory approval won't come for some time.
Now, to what might be the most significant signal yet about where the AI boom is headed. Silicon Valley is paying close attention to Stripe's deal to buy OpenRouter, a buzzy marketplace for artificial intelligence models. The price tag, $7.5 billion. Stripe is paying $1.5 billion to OpenRouter's founders and $6 billion to its investors. Compare that with the $1.3 billion valuation OpenRouter fetched just 3 months ago. That provides a healthy return to investors, including Andreessen Horowitz, known as A16Z, the startup's biggest shareholder with a roughly 17% stake, netting them nearly $1.3 billion.
Has the AI era entered its acquisitions phase?
Since ChatGPT shot to fame in 2022, AI startups have raised billions with ease. But some investors are getting more discerning, venture capitalists and startup founders have told DealBook.
For companies unlikely to dominate potentially huge sectors, selling, not fundraising or an IPO, may become a more likely outcome. Incumbent companies are racing to build their AI capabilities. Strategic buyers spent $50.5 billion for so-called unicorn startups in the first half of this year, excluding SpaceX's $250 billion acquisition of xAI, according to PitchBook. That's compared with $18.9 billion for all of last year. Stripe is already a giant in processing companies' payments.
Buying OpenRouter appears to be the company's deliberate attempt to embed itself into the middle of capital flows in the AI era, said Franco Granda, an analyst at PitchBook. OpenRouter's technology lets businesses direct their spending on tokens, the atomic unit of AI use, roughly equivalent to a word fragment, between different providers of AI models. In May, Alex Atala, a founder of OpenRouter, described his company as the AI version of Stripe.
Now Stripe owns it. Even AI companies are turning to M&A. Consider SpaceX's purchase of Cursor or its reported bid for Cognition, another major coding startup, according to Bloomberg.
And here's a storyline to follow. Stripe has long insisted it can stay private for a long time.
Buying OpenRouter mostly in stock and also pursuing a multi-billion-dollar takeover of PayPal with a private equity firm is a flex demonstrating why that's the case.
The payments company Stripe and Advent International have offered to acquire PayPal for about $53 billion, a deal that could reshape the fintech industry. Of particular interest to Stripe may be Venmo, which PayPal owns. Now, a story that reads like a Wall Street thriller. Years before the fashion tech startup Caesli imploded amid a $283 million fraud, one of Wall Street's savviest investors sensed something was wrong. Henry Kravis of KKR grilled Christine Hunsaker, a founder and CEO of Caesli, in 2019 over the startup's financial opacity. The details of that confrontation have not been previously reported.
Hunsaker is set to be sentenced today in a Manhattan federal court after pleading guilty in March to securities fraud.
Caesli, pitched as a kind of Shopify for clothing rentals, clothing as a service, promised to turn shipping boxes for Bloomingdale's and Banana Republic into a high-margin business. It disclosed last year that Hunsaker had been vastly overstating its financial results.
Hunsaker started Caesli in 2011 with Jaswinder Pal Singh, a Princeton professor. Singh helped bring in Kravis as an investor. Bill Ackman was also an investor.
Overall, Caesli raised more than $600 million and was valued at $1.25 billion in 2018.
By 2019, sales had started to stall.
Investors, including Kravis, put pressure on Hunsaker.
According to a sentencing memo prepared by Hunsaker's lawyers, Kravis, who invested his own money, began demanding detailed quarterly financial data. But his investment gave him access only to general annual financial information.
Before the 2019 meeting, Hunsaker created a false income statement and balance sheet she believed would satisfy Kravis. At the meeting, Kravis became hostile, repeatedly yelled and wiped the floor with her, threatening to ruin her career if she didn't start providing more information.
A KKR spokeswoman told DealBook, Hunsaker has a long record of deception. This latest fiction is a desperate attempt by a convicted fraudster to rewrite history and evade accountability.
But Alex Brick, a senior advisor to Swan and Legend Venture Partners who sat in on CASLI meetings as a non-voting board observer, corroborated Hunsaker's account. Hunsaker told me, "I have come from the most horrendous meeting with Henry. She literally said, he screamed at me." The board waited 3 months to tell investors about the fraud, and Hunsaker was allowed to stay on as CEO during that time, only forced to resign after the company got wind of a criminal investigation. Staying with governance questions, as Anthropic prepares for a potentially enormous IPO, it's taking a page from the biggest publicly traded tech companies, letting its founders maintain control. The information reported that the AI giant is set to provide its 7 founders, including Dario Amodei, its CEO, and Daniela Amodei, his sister and the company's president, with super voting stock that has more voting power than standard shares. But Anthropic appears to be doing things differently. It's unusual for a big block of non-family founders to have super voting shares. Most tech companies with multi-class stock restrict that power to 1 or 2 individuals. Google, where Sergey Brin and Larry Page control roughly 53% of the shareholder vote. Meta, where Mark Zuckerberg owns about 13% of the equity but controls about 60% of the vote. Or SpaceX, where Elon Musk gained super voting stock after not taking it at Tesla. The closest comparison is Palantir, where its founders Alex Karp, Peter Thiel, and Stephen Cohen collectively control the voting power in perpetuity. We have questions. Will all 7 founders have equal voting power? The information reported they each hold roughly the same amount of stock. What happens if there's a dispute? Ann Lipton, a professor at the University of Colorado Law School, told DealBook, "You would expect some kind of tie-breaking mechanism. The challenge of shared voting rights is that you don't know what the standoffs or quarrels are going to be. And there's a tax angle. California's Proposition 40, which would impose a one-time levy on the state's billionaires and is on the ballot in November, appears to value super voting shares the same as an equivalent amount of standard voting stock. That could supersize the Anthropic founders' tax bill." A few quick hits from the speed read before we go. Muon Space, a satellite startup, raised $250 million in funding led by Google and Salesforce Ventures. Shares in Marvell Technology soared after the chipmaker struck a deal with Google that could let the tech giant buy up to $12.2 billion worth of stock. The Commodity Futures Trading Commission banned 2 former FTX executives, Caroline Ellison and Gary Wang, from trading for 5 years over their roles in the crypto exchange's collapse. And Politico reports Trump backed down from 50% tariffs on Canada. "It's not a taco," as they put it. Finally, Prince Harry, Meghan, and their children are moving back to Britain after 6 years in the US and a clash with other members of the royal family. They'll remain non-working royals. And if you haven't read it yet, the New York Magazine piece "Everyone's Using This AI Dictation App That I Want to Murder with a Hammer," Amy X. Wong's column about Whisper Flow, is worth your time. She dictated the entire piece. That's your DealBook briefing for August 20th. We'll see you tomorrow. If you have thoughts or suggestions, email us at dealbook@newyorktimes.com. Follow us on Instagram at @NetDealBook. Have a good day.